YouTubers, Mike Martin's here, Mike Martin's channel. Thanks for joining me for another housing crisis video. I got a really hot one for you guys. It's been sent to me twice by one person and once by someone else, and then someone else from the US sent this to me to my email. I'm going to read it to you guys. It's really important. I was super busy today. I was just not focused on anything else but getting some work done here around the shop. Here goes. It's obviously from our boys over at Zero Hedge, and from our my esteemed best friend here, Tyler Durden. If you know who he is, you can remember some of his quotes. Your things end up owning you. Your possessions end up owning you. Let's get this off. Let's get this off. Mauldin, okay, quoting to say, flying blind at 20x on the brink of another housing-driven global crisis. If you watched Trends in the Housing Market last night, we were talking about this. Repeating history. History never repeats, but sometimes it rhymes. The trigger for our last recession and financial crisis was an excessively leveraged U.S. housing sector. Remember that? 2007, 2008, in case you were stuck under a rock. Other factors contributed, but home mortgages and housing speculation were the core, so it's easy to assume, obviously it was the core, but easy to assume that the next crisis, whenever it comes, and whatever causes it, won't be about housing. Well, interesting. That may not be right, though. Wow, U.S. homeowners and lenders learned some hard lessons in the last crisis. Again, 2007, 2008, in case you were under a rock. And while I don't see that kind of exuberance this time around in the U.S., I do see signs elsewhere. Canada is the most obvious case, but also Australia. They should put New Zealand in that. Come on, Tyler, get New Zealand in there too, in the UK. And parts of Asia and Europe. Imagine the rising interest rates and reduced foreign capital flows combined. Remember, capital outflows being cut back in China. Remember we were talking about this? And an affordability crisis for the Canadian, American, UK proper, can't afford to buy anymore. Push housing prices down, like in places like Vancouver. Wow, I've been talking about this place for friggin' 6 years. Leverage players who own speculative homes start to liquidate their properties, pushing prices down further. Banks find themselves holding properties they neither need or want. The dominoes begin to topple. So, we might have another housing-driven crisis, but starting elsewhere, it would still affect the United States, and differently from the last time. Our healing ointment could have a fly in it, and it's definitely a fly in that healing ointment, people. Anyways, so, flying blind at 20x. What does this mean? I discussed this the other day. I was discussing 12x yesterday. The housing sector has two characteristics that lead to these problems. First, it's highly leveraged. And we've been talking about people riding off the coattails of their equity. Remember that, people? In the U.S., it's common for people to buy houses with only 5-10% down on the purchase price in cash, leaving the buyer instantly leveraged at 10, 20 times. That's asking for double trouble even if the sale price is fair. And it's often not, from what we've been seeing around the world, right? Price is the other rub. Oh, the rub of the ointment, I get it. Houses are liquid because the transactions occur frequently, and each property is unique. They aren't like shares of stock. You can look at tax and valuations and appraisals, but those estimates you can really know a house's value until you sell it. Exactly. Remember, it's only worth what someone's willing to pay for it. Flying blind, the 20x leverage, is that the ideal way to learn about investing, but that's how many Americans do it. We've even convinced some of our closest neighbors and allies to adopt our ways. And this goes back to the last video I was talking about, how delusional people are. Last week, Josh Thainer, Hedged Kindly, sent to me a slide deck of assembly of housing in Canada, Australia, and the US. It was a revelation. Consider the following chart. There's the chart right there. Note on the sidebar right there, the sidebar right here, sorry, on the sidebar, on a relative basis broker commissions and other ownership transfer fees have eclipsed levels breached during the U.S. housing peak. Those fees are now 3% of the Canadian GDP. Really? GDP? Remember when I kept talking about we're not fabricating? We are tied. We are fabricating, producing. We are tied to the housing market. How is this producing anything other than income for brokers? Look at this, people. Anyone that could read graphs, there's a Q's right there. Anyone that's educated enough to read these graphs knows that things aren't going good in Canada. Remember the 2008? Let's see if that goes, that right there's the 2008. Let's go back here. 2007, 2008. That was right. Right there. Goes right there. Canada. Woof. 2008, you got a dip, but that was just a little bit of resuscitation here, and you're back on track here. On relative bias, broker commissions and other ownership transfer fees have eclipsed levels reached during the U.S. housing peak. Of course it has eclipsed. With lesser population and lesser units on the market in Canada. Wow, Canada's up for... Let's just keep reading. I'm going to stop talking. The two lines represent the real estate transaction costs and in the U.S. brown and Canada black percentage of GDP. We're so tied to it, it's not even a joke. We see the costs peaked in the U.S. in 2005 and fell rapidly the next couple of years as the economy tumbled into recession. Who remembers that? The bailouts and the bail-ins and all the bails. Canada's less exuberant at the time, but post-recession housing in Canada climbed far faster by the U.S. nearly 2017. Canadian home buyers and sellers were spending as much housing as relative to their economy size, and the U.S. did at its 2005 peak. Meanwhile, you have a Bank of Canada rising rates slowly but surely. This seems like an anonymous combo. Now, you could argue that Canada has something the U.S. didn't. Cash-bearing Chinese buyers. That's what America was lacking back in 2007. Those buyers might make higher interest rate less harmful to home prices. True enough, but other things could discourage prices. We'll come back to that later. The situation in Australia is even crazier. You know, guys, I just have a little slight deja vu, and you know why? It's because I've been talking about this for 6 years. The situation in Australia is even crazier. Down under, our Aussie friends. Let's not forget the New Zealanders, our Kiwi friends. At least Josh describes it. He works with the indicator that never occurred to me, and the crane count and the number of cranes operating in the city and the kinds of properties that are being used to be built turns to be a pretty good measure of housing activity. Of course it is, because it's a giant Ponzi scheme. The chart below shows the crane count for Australia's largest cities. As of 3 months ago, Sydney had 350 cranes. We used to build high-rise residential properties. That's more cranes were developed in all of North America's 12 largest cities. Construction booming. Australia, in fact, that the comparisons is even more stark. Or per capita basis, Australia has 14.6 times as many residential construction cranes working as North America does. Look at that, guys. So, do you remember the article? I read a whole article about these cranes, about all these booming cranes and all these places that are, there's Sydney there's Perth, Melbourne, and Brisbane. It's nuts. Perth is at the lower end of the spectrum, but still, look at this. 350 cranes? Man, you should be in the crane business leasing these damn things out. That's the business you should be, not the housing business. It gets crazier still. Oh, okay, brace yourselves, people. Australians engage in negative gearing for tax reasons. People initially buy investment property that produces losses. We do that in the U.S. too, but we have ways to keep cash flow positive. Even as properties produce tax losses in Australia, investors get interest-only loans and buy properties. Then rent them out for less than the loan payments absorb the difference, and then they will make it up selling at a profit. John Steiner described this way. Negative gearing and should be a truly bizarre concept to an investor. But remember, I don't know if you guys remember the whole friggin' 20-minute discussion I did about this concept. But it makes perfect sense to most Australians because home prices have only gone up for the last 25 years. Wrong! For the last 39 years. These perspectives are genuine belief that they can't lose. If this is right, and I'm sure Australian readers will tell me, it will likely end up in disaster. But actually, I get why younger Aussies might think this way. Those under 40 have never seen the... 40 in Australia have never seen the recession in their adult lives. They have seen a resource-driven boom as Australia exported staggering quantities of raw materials to China. That incoming cash kept the country afloat. Remember mining towns in Australia where the housing's been dipping, or dipped a lot. Even others sank. It's easy to think that the condition is normal and you haven't known anything else. So, like I said, people that were in this whole in Australia's had a bull market for 39 years right now. It's pretty much my age, 1979, and that's what's been happening, guys. Now, what am I talking about? The 12x. The average house in Vancouver is 12 times the average person's the medium family income is 12 times. And then we're looking at Fort McMurray and my show, Trends in the Housing Market, by the way. We're looking at Fort McMurray, and we're looking at that other Montcalm. I don't know where that city is, but that's like 1.5 or 2 times your annual income, which that's normal. And then when I tell people, look, the average house should be $300,000 to $400,000. Go back to the video I made a few videos ago, trying to make a deal fit with the new lending, new lending rules. And I got an app from CIBC to try and make a deal fit for a $700,000 townhouse in Coquitlam that's in a real market. It's probably worth $210,000, but I tried to make that deal fit. Look at that deal. Anyways, let me know what you guys think. I'll leave a link below to that deal. That deal I was trying to put together to try to make it fit. Let me know what you guys think. Thanks for watching, and let's see what happens. And I want to thank Zero Hedge for this article, and my man Tyler Durden. Remember, the things that you own end up owning you.